Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Today, we'll be looking at the outlook for emerging markets. We'll be joined in a moment or two by Stephen Quattry. He is the EM Equity Portfolio Manager at Morgan Stanley Investment Management. But first, we go to Hong Kong and bring in Ben Luck. He is the Senior Multi-Asset Strategist at State Street Global Markets. Ben joins us from Hong Kong. It's always a pleasure, Ben. Can I begin by getting your reaction to the things that you're hearing from the incoming Trump administration as it relates to tariff policy? How do you think this is going to play out in markets over the near term?
Right. I think in terms of obviously all of these policies, the clear trend is obviously going to be positive for the U.S. and net negative for anybody basically in the rest of the world, or in particular EM. But when we actually think about it more on how investors should be positioned, whether or not there are areas where is already overweight or underweights that we need to, the story is a little bit more complex, I think. Although from a more top level multi-asset approach that we have, we're still long the U.S. exceptionalism story. That hasn't changed. But it doesn't mean that we are actually outright negative on everything, Doug. I mean, we are still positive on selected parts of EM Asia, in particular places that we believe are less reliant on the U.S., less correlated with U.S. assets in particular. So places like Indonesia is an area that we actually like the most in terms of both the FX and the bond space. With respect to equities, we are a little bit more concerned, obviously, in terms of, let's say, China and Korea, places that obviously are much more reliant and dependent, I would say, in terms of what the new administration would do. But in terms of just looking at it from an earnings perspective, we're still liking what we see in Taiwan. That remains to be what is the biggest chunk of our overweight, given really our strong preference towards U.S. tech and the spillover from that towards the region's equity. So that's what we're doing right now. We're still trying to get a sense of some of the policies, but we still need to be positioned in general. So focusing on the U.S. and selected parts of EM Asia.
We also had the minutes from the last Fed meeting during the last session, and they show kind of broad support for what may be described as a careful approach to future rate cuts, and maybe even, if inflation were to remain elevated, a pause in rate cuts. So this notion that maybe inflation could remain elevated, do you think that is in any way related to Trump's economic plans?
I think that revolves around the expectation side, Doug. Again, a lot of how yields are priced in is either based on inflation expectations or obviously the surge or movement in the term premium as well. I think the term premium story would be much more driven by the potential Trump administration and how those fiscal stimulus are going to come through, whether or not we'll see more radical policies or even policies that actually impact the rest of the world as well as the U.S. But in terms of future inflation expectations, I still believe it's more driven by the U.S. domestic economy. Labor market strength is still there. Yes, it has weakened a bit, but we consider it still as relatively tight. Inflation, we like to track our own inflation using online price stats. This is a daily measurement of online products, and we continue to see still very sticky inflation. So I think that's also going to be, I would say, a challenge for the Fed to continue to cut rates next year. For us, the expectation is they will still move in December with another 25 bips cut, but next year is really going to be more driven by whether or not we'll see a much slower movement in the labor market numbers, which will obviously warrant a bigger cut. But I think that's still a wait and see mode. So the next year anticipation for us still would be more towards just a two cut would be something that we expect for now.
Ben, I want to get your view on China. We just learned that industrial profits in China during the month of October were down about 10% from a year ago, and we are well aware of the deflationary pressures that have been plaguing the economy on the mainland. Is this something that you're concerned about, that if not corrected could become a little bit more entrenched in the Chinese economy?
Yeah, so again, looking at our own inflation using that price stats method that I talked about earlier, we've actually seen Chinese prices in particular being in deflation for more than 2 years already. And that's really on the combination of the lack of pricing power from producers, as well as really the lack of spending in general in Chinese consumers, as a way to put it. I think it clearly signifies that a lot of the hype or announcements that Beijing and the government has highlighted are good to boost near-term sentiment in terms of risk assets, but it doesn't really solve the underlying credit problems. We're still seeing deterioration of credit across both households and businesses in general in China. And this is something that they really need to fix next year, because it will spiral down to much lower expectations in terms of prices as well. And that will spiral down even more into lower earnings growth in terms of Chinese equity. So I do anticipate that irrespective of what the Trump administration will do towards targeting China, they still need to do a lot more in terms of pushing for much more actual stimulus packages to support the local economy.
So what might that look like? If you were to recommend to policymakers in Beijing an approach, can you give me a sense of how that may take shape?
Right. I think a lot of what we have seen so far, to be honest, Doug, is really kicking the can down the road approach. The numbers sound big, but they're mostly swap programs. So they're really just trying to transfer the risk, let's say, from local governments to maybe central governments as a way to help them ease. To me, that's really not going to help them in the medium term because it doesn't stimulate enough. The easiest way, again, is to really focus on actually new credit would be would be the most important thing. Having actual figures that actually drives new credits. Let's say if it's actually 2 or 3 trillion in terms of new credit creation, that could obviously help to spur more incentive in terms of Chinese consumers to spend. On the other hand, I still think it's also a currency approach where they need to let go of the currency because of how tight policy is if currency remains to be overvalued. For us, it's still overvalued given how weak the local economy is. So I do see higher dollar CNY going next year as another way to really help loosen out that credit and liquidity to the system.
So do you think that there are more opportunities in the fixed income space in China rather than on the equity side?
For us, yes. I think there's a more clear story to see that the PBOC will directly inject or directly support the liquidity system, which will obviously drive yields lower. Although it's obviously extremely tight already and valuation is expensive, but it is a more, I would say, easier approach in terms of actually seeing where the support is. On the flip side, the equity space is a lot more geared towards whether or not we'll see sustainable earnings. This year, again, equity markets are up, but earnings haven't lived up to the same expectation. And if next year remains to be the same, then I anticipate that the foreign flows would actually start to leave the country if they don't actually see concrete fundamental improvement. So I would see more of a bond space and actually hedging the currency to get better return as opposed to focusing on Chinese equities.
Ben, we'll leave it there. Thanks so much for being with us. He is Ben Look, Senior Multi-Asset Strategist at State Street Global Markets. Ben joining today from Hong Kong here on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. We go next to President-elect Trump's economic policy, and his use of tariffs, I think it's fair to say, is a centerpiece. Joining us now for a closer look is Stephen Quattry. He is EM Equity Portfolio Manager at Morgan Stanley Investment Management. Stephen joining from here in New York City. Thanks for making time to chat with us, Stephen. We just learned that the president-elect is set to name Jamieson Greer as U.S. Trade Representative. He's a longtime protege of Robert Lighthizer, who served as USTR in the first Trump administration. And Greer was a key part of the president-elect's first-term trade negotiations. It seems to me the message is unmistakable. You got to use tariff policy to force negotiations on trade agreements. Do I have that right?
I think that's right. I think that he's been very clear about wanting to use tariffs as a policy tool. I think the degree to which they will raise tariffs is sort of up for debate. Some of the signs to me suggest they are being used as a negotiating ploy. So starting with the worst possible scenario, but I think time will tell. I think we need to see this administration come in and start to get to work before we can have any real clarity.
Yeah, Canadian Prime Minister Trudeau as well as Mexican President Sheinbaum both suggested possible retaliation. We didn't get that definitely, but it's looming as a possibility. Is that a real risk when you look at companies like Ford Motor and Ford that are exposed to those markets and have manufacturing sites in those countries?
I think it's definitely a potential risk, but there are some potential offsetting factors as well. Remember that the last time tariffs were imposed, the inflationary impact could be offset by the sort of disinflationary impulse of lower commodity prices, and so that certainly impacts the demand for autos as well. And so I think it's really hard to say. It's a very complex system. We focus on bilateral trade, but as we know, trade tends to happen in various ways beyond just a bilateral trade. So a little hard to say at this juncture, but certainly something we are watching anxiously.
So when President-elect Trump made the announcement about the threats of 25% tariffs on Canadian and Mexican goods, he also talked about imposing an additional 10% tariff on Chinese goods, on top of the levies that also exist beginning his first day in office. Talk to me about U.S.-China relations and the use of tariffs to try to maybe construct a more level playing field. Is that even a possibility?
I think that the ability to use tariffs to construct a level playing field, it's going to be a bit difficult. As we know, labor costs are quite different in these countries. There's a number of different sort of structural factors, but it's possible that this administration certainly tries to do that. Time will tell how successful they are, how much the currencies would need to adjust. But so I'm a little skeptical that tariffs can actually do the sort of brunt of all the work that needs to be done. But time will tell. It's really hard to know at this stage.
Well, we do know that the Chinese economy is still struggling, and the export arena has been one of the bright spots. This certainly represents a big headwind for Beijing, does it not?
It does. However, let's remember that the last time that tariffs were enacted on China in 2017 to 2019, they simply shifted their exports to other emerging markets. And we saw that share rise quite a bit. So clearly China is, we like to say over indebted, over leveraged and oversupplied, and they are exporting that oversupply to the rest of the world. If they can shift enough of it from the U.S. to other emerging markets, and those emerging markets sort of accept that disinflationary impulse, then that's a possible route. It also has that nice effect of helping them build this sort of other BRICS coalition that it seems to be they want to build. So it's one route they can take. But certainly at the end of the day, it does seem like China is going to need to stimulate their own economy. They can't seem to simply rely solely on exporting their excess supply.
No doubt about that. And when you talk to people who put money to work in markets these days, I can't tell you the number of people that have been on this podcast talking about the fact that it's not yet time to put money to work in China. Are they missing anything? Maybe not in China, but other markets in the APAC region that may in some way be connected to China?
I think there's a lot of focus on the superpowers of China and the U.S. and not enough focus on what I'd say are the middle powers. And so when I think of markets in Asia that are maybe not in the direct crosshairs of tariffs, you can think of markets like Indonesia, the Philippines, even India, which just have a larger share of domestic demand. For better or for worse, they have not relied on exports as a channel. So I think some of these markets, are quite interesting. They're home to many structural themes that you can gain exposure to by investing in them. So I think certainly that's where we're focused at the moment, away from China and some of these other countries that are in the direct crosshairs of tariffs.
But I'm wondering, as you look out to 2025, whether EM will still struggle, given the fact that developed markets like the U.S. seem to be performing very, very well.
I think the bull case for emerging market equities is maybe delayed, but I don't see it as derailed. And that's simply because, the economic fundamentals are much better now than they have been over the last decade. You certainly need to take a country-specific approach, and as I've said, sort of focus on the winners and losers. But I don't think that making a broad brush emerging markets won't do well is a bit too far than I'm willing to go. Again, because of those fundamentals. And again, if you look at certain emerging market countries, they are seeing growth accelerate quite a bit, all the while growth is slowing down in some large economies. So ex-China, maybe even Korea, Taiwan, where growth is shifting down. There's some really interesting growth stories in emerging markets that we tend to focus on.
So within those realms, are there themes that you really are attracted to, whether it's in support maybe of the consumer in those jurisdictions, or maybe it's more on the industrial side? Talk to me about the themes that you like right now in EM.
Yeah, I think on the consumer side, we're really focused on some structural themes. And some of the smaller emerging markets, you're seeing the rise of the middle class. So in places like Vietnam, where the country is urbanizing, they're shifting their retail patterns away from wet markets, more towards traditional retail. In a place like Indonesia that simply hasn't built out their healthcare infrastructure, but has recently become the largest healthcare scheme in the world in terms of universal healthcare. So I think a trend like that is set to continue. The country will continue to build more and more hospitals, irrespective of what's going on in tariffs, simply because the infrastructure is not there. So I think there's plenty of these sort of classic emerging market themes that are uncorrelated maybe to tariffs and what's going on in global trade. And frankly, some of them are trading at pretty interesting valuations of 12 to 13 times earnings. So plenty of things to like in these markets.
Stephen, we'll leave it there. Thanks so much for joining us. Stephen Quattry there. He is EM Equity Portfolio Manager at Morgan Stanley Investment Management, joining from here in New York City on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.